G'day guys. Simon here again from the Profitable Fencer. This is my podcast, A Fencer's Life Lessons from the Trenches. Today we are going to get into something juicy, and before I get into today's episode, I will owe you an apology because it is long and it is data driven. The episode has more data and numbers in it than any other episode that I'll probably ever record. So I know that might make some of you want to switch off right now, but I'm asking you to stay with me. I promise I'm going to make these numbers as simple as possible and as practical as I possibly can. I'm going to use real fencing examples. They're not textbook theory. They're things that I've done in my past and on my jobs. And by the end of this episode, you'll have a framework that changes the way you price every single job for the rest of your career. But I would be doing you a disservice if I sugarcoated it. This is the episode where we get into the engine room, the numbers that actually drive the profit, and the numbers that most fencing operators either don't know, or generally what I see is they get them completely wrong. So grab a pen. If you're driving, pull over, or just listen and then come back to this, because this one is really worth your full attention. This episode is called episode 2 of series 1 of the 3 money buckets, and numbers worth gold. If you don't price these 3 things, you're losing money on every job. So let's get into it. Let me ask you a question. When you price a job, what are you actually pricing? Most operators say materials, labour, maybe a bit for overheads, and there's your price. But that's not 3 things. That's 3 vague categories with no structure, and vague categories mean vague pricing. And vague pricing means money falling through the cracks on every single job. Today I'm going to give you the 3 money buckets that every profitable fencing job must fill. And I'm going to show you exactly what goes into each one, how to calculate it, and how to make sure you never underprice again. I'm Simon. This is a Profitable Fencer. Let's talk money. Why 3 buckets? So every fencing job, residential, rural, commercial, doesn't matter, has exactly the 3 cost components that need to be priced correctly and recovered in full for the job to be profitable, for you to make money. Miss 1 bucket and you're subsidising your client's fence out of your own pocket. Miss 2 and you're working for free. Miss all 3, which most operators do more than you believe, you're actually going backwards and turning over money and losing wealth at the same time. So the 3 buckets are these. Bucket 1 is in-store recovery, your labour, your time, your skill on the job. Bucket 2 is your materials margin. Not just cost, but margin on every item supplied. Bucket 3 is your overhead recovery, your share of fixed business costs on every job. 3 buckets, every job, every time, non-negotiable. So let's go through each one in detail, and I want you to be thinking about your last 3 jobs while I do this, because I guarantee you at least 1 bucket wasn't full. So easy to miss. Bucket 1, your in-store recovery. So this is your labour, your time, and your skill. So in-store recovery is about pricing your time and your crew's time properly. This is not just pay rates, it's the cost of putting labour on the ground, then recovering a margin on top of it. What most operators get wrong. So most fencing operators that I've talked to price labour at their hourly rate plus a rough buffer. I charge it out as metre rates on the job, but this is how they would come to get their sort of hourly rate scenario. I pay my guys $35 an hour, so I'll charge $55, keep $20. That sounds okay until you factor in what you've actually spent to employ that person. Okay, so they think they're making $20 per bloke per hour. Your real labour cost is not $35 an hour. It's $35 plus superannuation, plus workers' comp, plus downtime between jobs, plus the cost of tools and the equipment they use and the breakages they have, plus your time that you manage them. By the time you add it all up, $35 an hour is costing you closer to $50 to $55 an hour in real terms. And if you're just charging that $55 to recover that cost, you're covering your costs and nothing else, and there's no margin in that bucket. There's no profit, and you're just breaking even. So here's the formula I use and teach inside the profitable fencing program. We start with your base hourly labour cost per person, fully loaded costs including super, workers' comp. Then we add equipment and tool allocation per hour. Then we add our vehicle cost per hour on site, and then we apply a target labour margin percentage on top. So for an example, base labour cost is $52 an hour. Tools and equipment might be $8 an hour. Vehicle allocation is $6 an hour. So that equals a total cost of $66 an hour. We put a target margin of 30% on it. So the charge rate equals to $66 divided by 0.7, which is your 30%, equals $94.30 per person per hour. So we round it out to $95 per person per hour. That is our install recovery rate, not $55 that we talked about earlier. The gap between 55 and 95 is where the profit lives, and most operators are charging $55 per person per hour, wondering why they can't get ahead. The hours problem is massive in our industry because, as I said, we go to meter rates or per foot rates. But the second part of the install recovery is the actual hours that are worked, and this is where the scope creep destroys our margins that we've built in. So you can quote 12 hours for the job. The job takes 16. You absorb 4 hours of unrecovered labour because you don't want an awkward conversation with a client. Hands up, how many times have we done that with our clients? We've done a little bit extra. Look, the price was the price. We'll just sit with it. But at $95 an hour, for example, that's $380 that just walked out of your business on the job. Do that 3 times a week, you've lost over $1,100. Do it every week, and you've lost 57 grand in a year on a single issue, hours not recovered. And the fix, there is a fix for it. The fix is a proper variations process. Any scope change gets a variation notice and an updated price. And we'll cover that later in detail in another episode. But for now, know that your install recovery bucket leaks every time you absorb unquoted hours. Now, I just want to let that sit with you for a minute. How many times have we gone onto a job and done extras or lost hours because the job has run over that time? I want you to work out or think about how much money you've lost or you're leaving behind. So that's bucket 1. Bucket 2 is the materials margin. So this is not just cost. This is a margin on every item. And I think this is something that will change how you think about materials forever. I've had this discussion so many times with other fencers, and a lot of people don't think about it like this, but they think they will let the customer have the cost, and then they'll put it on their labour, for example, and they end up losing both ways, as we've just worked out in the bucket 1. But I digress. You are not a material supplier who does installation. Okay, that's number 1. But if you're pricing materials at a cost, that's exactly what you're acting like. Now think about what that actually means. If you supply materials that cost zero margin, no recovery, you just pass through the pricing, you're taking on all the risk of being a supplier with none of the reward. You're ordering it, you're chasing delivery, you're checking it off when it arrives, you're handling it on site, and if it's wrong, damaged or short supplied, you're the one wearing the problem, not your supplier. So here's the test I want you to apply. If you're not going to charge margin on materials, if you genuinely believe you should supply at a cost and take the risk away completely, tell your client to source and pay for the materials themselves. You just show up and install it. A lot of rural fencers will do this. The farmer buys all the gear and the contractor just goes in and does his job, either on a meter rate or a hourly rate for yard building, things like that. Which is okay if that's the way you want to work. What I'm saying is don't be the risk taker and do the supply and earn nothing for it. Why bother being the middleman if there's no margin in it for you at all? Seriously, why would you tie up all your cash flow, ordering materials, carry the risk the price fluctuations, deal with delivery, dramas, short orders, and then hand it all over to a client at cost. That is not a service you should be providing for free. And I can guarantee you this, the moment you say that out loud, just source the materials yourself to your client, most clients will look at you like you're crazy because they don't want to do it. They don't know the suppliers. They think you're getting a better rate. They don't know the specs. They don't know the quantities. That's exactly why they've hired you. And that's the expertise, that convenience, that supply chain access. It has a price and your job has to charge for it. Okay, so I really want you to think about the way you're charging for your materials. The principle of the matter is this: every item of material you supply to a job should carry a margin, not just a markup to cover handling and waste, a genuine margin that reflects the value of you sourcing, ordering, delivering, managing, and warranting that product. Think about what happens when you supply materials on a job. You order them, sometimes from multiple suppliers, you organise delivery or collect them yourself, you store them temporarily, you handle them on site, and if something is wrong, defective, damaged, wrong specs, it's on you to fix. Again, how many times has this happened to you in your business? I know for me personally, this has happened on multiple times, and I've had issues with different suppliers where things have turned up and they've been wrong, and the supplier will change it because it's their error, but then I'm caught in the middle with the client, trying to explain to the client and trying to fix it, and I've had the lag time, the downtime, and everything else. So if I have to go through that hassle of doing things, I want to be able to charge for it. And that is a service that we provide, and that service carries margin. So you guys need to think about the same thing. So margin versus markup. This is where a lot of you guys get it wrong, and that mistake will cost you thousands on the bottom line of your business. And before I give you the numbers, I need to make sure we're speaking the same language, because the confusion between margin and markup is one of the most expensive mistakes in the trades business and the construction industry. Margin is profit as a percentage of the sell price. Markup is profit as a percentage of the cost price. So markup is profit as a percentage of the cost price. They sound familiar, they are not the same. Let me give you an example. Again, numbers based. Materials cost you $4,000. You add a 30% markup, your sell price equals $4,000 times 1.3, which is your 30%, gives you $5,200. So you've got a profit of $1,200. But what is your margin? Your margin is $1,200 divided by the $5,200 equals 23%. You thought you were on 30% with the markup, but you're actually only on a 23% margin. Okay, now flip it. If you want a 30% margin, that means profit must be 30% of the sell price. So for example, again, materials cost $4,000. To achieve 30% margin, the sell price equals $4,000 divided by 0.7, again, which is 30%, equals $5,714. So the profit now is $1,714. That is $514 more than the markup method on the same job, same material, same client that we had in that previous one, because we got them around the right way. So over a year running 40 jobs with $4,000 average material cost, the difference between a 30% markup and a 30% margin is over $20,000 in additional profit every year from understanding one simple formula. And for you guys who are out there on the tools, small businesses working away, that's $20,000 in your back pocket that you can change like that. So easy. You just got to get to know what you're doing. So let that number sink in. You want an extra 20 grand in your business? That's where you can find it. Simple. What margin should you be running on materials? Okay, this is where it gets rubber hits the road, I suppose. This depends on your business model. It depends on your supplier relationships and your market. But as a general guide for fencing operators in the current market here in Australia. If you're running your business as a commodity item, standard steel posts, plain mesh, basic palings, colour bond, 20 to 25% margin is minimum. There are clients, these are the items basically that clients can actually price check on you. So your margin here is about efficiency and volume. So they can ring up Bunnings, a big hardware chain that still sells the standard items, and they can do a price check themselves. Yes, you may get it at trade price, but you want to be selling it at a minimum at retail value. So if you're getting trade price, you should be sitting around the 20 to 25% margin, and you're right. But your speciality or sourced items, the custom colour bond profiles, speciality timber, decorative steel and work, gates with specific hardware, you can get to 30 to 40% margin. So you've done the work to source these, you carry the risk. So again, you price accordingly. Concrete consumables and fixings generally will sit between 30 to 45% margin. These are small ticket items individually, but they add up across a job. So if you're not running a margin on concrete and fixings, you are gifting money to every client. Another thing you got to think about is your wastage and offcuts. So every job produces waste, offcuts, broken posts, split palings, concrete spillage. This is a real cost, and it needs to be in your materials pricing. So a 5 to 8% waste factor on every material line item is not padding, it's probably a reality. So if you're not building waste into your materials cost before you apply margin, you're eating that waste out of your own margin every job. So again, if you're not putting your markup and margins on top of your jobs, you're leaving so much money behind in your business that can help create that profitable business and that relief that you feel when you know you're actually making money and you know you're doing everything for a purpose and you're getting paid for it. Bucket 3 is your overhead recovery. Now your overhead recovery, that's the share of your fixed business costs on every job. So this bucket is where most fencing operators either forget completely or they bolt it on as an afterthought, and it's the one that causes the most confusion at the end of a financial year when the numbers don't add up. So what are your overheads? Your overheads are every cost your business incurs whether you do a job or not. So these are the costs of being in business, not the cost of doing a specific job. Okay, so your list will include wages and your own wages and drawings, your accounting fees, your insurance, public liability, workers' comp, vehicles, phone and data, software subscriptions, advertising and marketing, vehicle registration, maintenance on non-job vehicles, office costs, training, any finance repayments on equipment, said subscriptions. Yep, add all of that up for a month, and that is your monthly overhead cost. And every single job you needs to contribute to try and cover it. Okay, so you have to cover that part out of the jobs you do. So the overhead ratio, this is a really important calculation, but here is how you can calculate your overhead recovery per job. So step 1 is calculate your monthly overhead cost. So let's say it's 18 grand. Step 2, you estimate your monthly revenue. Let's say that is 75 grand. Step 3 is your overhead ratio. So you divide your monthly overhead cost, 18 grand, divided by your revenue, 75 grand, multiply it by 100 equals 24%. Okay, so it gives you a percentage of your overhead. That means 24 cents of every dollar you invoice needs to go directly to overhead recovery before you make a profit. Now, let's put that to a specific job. Okay, and I'm reading these numbers off real jobs that we've done over the past and seeing where the difference is that's made us money and where we've lost money as well in our own business. So we've adapted pretty quickly. Say a job is invoiced at 12 grand. Your overhead contribution required is 24%. So it's 12,000 by 24% equals 2880. So if that job doesn't generate at least $2,880, in contribution after direct costs, it's actually costing your business money to do that job. Okay, so your direct costs are all your materials, and your $2,800 left is your overheads that have got to pay for it after your materials come out, your labor's come out, your fuels come out, those things. If you can't cover that, you're working for free. So example one here is a job revenue of 12 grand. Direct materials cost is 4,200. Direct labor cost was 3,100. Your total direct cost is 7,300. Your gross profit is 4,700. So that's 39.2%. Your overhead contribution required is 2,880. So your net contribution after overheads is 1,820. That is your real profit on this job, not the 4,700. Okay, so remember your overhead contribution comes out of the gross profit. Okay, and what's left over is your net profit. That is a number most operators never see, and they will, we all jump up and down and celebrate the gross margin. And so we're making plenty of money, but they never calculate what's left after the business costs are actually covered. And that's why sometimes you struggle to pay wages, sometimes you struggle to pay yourself, sometimes you struggle to pay your insurances. It's because you're not calculating the overheads that need to come back into the business or your break evens. So here is a more sophisticated point that the operators in my program love, is proportional overhead allocation. When you run jobs of very different sizes, it doesn't make sense to apply the same overhead dollar amount to all of them. So a $3,000 resi job and a $90,000 commercial project should not carry equal overhead contributions. The larger job uses more of your business capacity, more quoting time, more coordination, more management, more risk. And what we see is most operators apply a flat rate across all jobs. Proportional allocation gives you a more accurate picture and often reveals that small residential jobs are far less profitable than they appear once overheads are correctly assigned. I'm struggling with this in my own business at the moment because I've now pushed my overheads to where they need to be, and the smaller jobs are not cutting it for my type of business that we run. Let me give you an example. Monthly revenue, 2 jobs. One's job A, 90 grand, job B, 10 grand. Monthly overheads, 16 grand. The proportional split is 9-1. So job A carries 14,014 of overhead. Job B carries $1,600. So if you apply this when quoting, it means your commercial work is properly priced for the weight it actually puts on your business. Okay, so we really need to think about that. That's 2 jobs done in the same month, so you've earned 100 grand for the month, but 2 different jobs, and you split your overheads to marry up. Hope that makes sense. I know that's a bit hard to wrap your head around, but that's the easiest way to do it, because your job B, for example, can't carry your 16 grand of overheads because it's only a 10 grand job. So you have to split it down to a certain measure, whereas your 90 grand job could. The break-even reality check. One more number I think you really need to know cold, and that's your weekly break-even. So take your monthly overheads, divide them by 4.33. That's what it costs you every week before you put a post in the ground. 4.33 is because there is not always 4 weeks in every month. As you will look, if you follow your calendar directly, there are extra days in it. Sometimes it's 4.5 weeks in it, and that breaks. That's just the math. I don't know how the math works, but that's just the math. But yeah, take your monthly overheads divided by 4.33. So if your monthly overheads are 18 grand, your weekly break even is 4,157. So every Monday morning that debt exists. Your jobs that week need to clear before profit even begins. Okay, you have a slow week. You only do $3,000, for example, because you're in between jobs or something like that. And it costs you, your turnkey, as they like to call it, is $4,157. So you're $1,057 behind the eight ball before you get up on a Monday and turn the key to the door to start operating for the week. So you really need to work that out for yourself. And that's something at the Profitable Fencer we can help you go through. When you know that number, you stop taking on margin destroying jobs just to stay busy, because you now realize that a bad job, one that doesn't cover its three buckets, doesn't clear your break even, it actually adds to it. And this is where it gets really, really difficult for you. So how do we work through all of this? I've developed a cost analysis. Everything I've just walked you through needs to live in a system, not in your head. Too hard to do it in your head. You just won't sort of survive breaking it down each week. You can't live on a scrap of paper. It's got to live in a proper cost analysis that you run on every single job before you quote it. So again, please, I know for the life of me, I have done it for years. Everything was a basic meter rate. If it was a timber fence, it could have been, $100 a meter. If it was pool fencing aluminium, it could have been $110 a meter. If it was Colorbond, it could have been $80 a meter, whatever. I did that for years and years and years and wondered why I struggled so much trying to manage the money. And basically it was because the money wasn't filling the buckets. There's always one empty. So we developed this cost analysis. It's a pre-job version of back costing, actually. So before the job, you build your three buckets. Your install recovery is calculated at your real rate for hours required. Your materials are priced at your cost plus your margin target. Overheads are allocated proportionally based on the job size, and you add those three together, and that's your minimum quote price. Anything below that number, you're losing money on the job. There is no negotiation below the cost analysis floor. So this is the difference between pricing from knowledge and pricing from a gut feel. One gets you out of bed excited, and the other gets you out of bed anxious, wondering if you're making money or not. And we know we lose time on jobs because of unforeseen things, roots, rocks, cables, whatever, terrain. There's some things that sometimes you just don't see or you miss, and the job's hard enough. So you want to really, you don't want to be staying up at night worrying about where the money's coming from before the job's even started. So the pricing structure, once you have your cost analysis, your pricing structure is how you present that to clients. You can do line items that show materials. You can do installation and any additional costs clearly, professionally, and with confidence. Operators who know their numbers quote with certainty. They don't hedge. They don't want discount to win. They present a price, they stand behind it, and they let clients who want to negotiate on price walk to somebody else. A good thing that I've said that I've learned the hard way, one of the biggest words in my vocabulary now is the word no. The more I say no, the more in demand we have become in our company, because I will walk away from jobs that don't tick the right boxes for us and that are going to put too much pressure on the business. Because here's the thing, a client who is primarily shopping on price is not your client. A client who values quality, installation, reliable service, and a professional operation, that's your client, and that client will pay your price if your pricing structure communicates the value behind it. Okay? The client will pay your price if your pricing structure communicates the value behind it. The final piece is margin control, monitoring your actual margin against your quoted margin on every job. This is where the back costing comes in, and after every job, what I have done at North Coast Fencing is I have done a back costing, and I find out what did I quote in each bucket, what did I actually spend, what was the variance, did I meet my targets, did I hit my margins. I have target market margins that I try to achieve, so I want to know if I'm hitting them. And over time you'll end up seeing the patterns. Certain job types consistently blow out in labour. Certain materials will always come in over budget. Certain clients always want scope changes that eat your install hours. So margin control is not accounting, it is operational intelligence. It tells you where to fix your pricing, where to tighten your process, and which jobs to stop taking. Okay, I'm sorry. I told you this episode had a lot of data, and it did. So let me bring it back to simple truth underneath all of it. Every job you price has 3 money buckets: install recovery, materials margin, overhead recovery. If any one of them is underfilled, you are subsidizing your clients out of your own business. The operators who get this right don't necessarily work harder. They don't have more clients or bigger crews. They just understand what a profitable job actually costs, and they're priced accordingly every single time. And that's the numbers of gold. That's not magic. It's not complicated theory. It's just the right numbers applied consistently. So here's your action from this episode. If you've managed to get to the end of it and you're still listening, go to the profitableFencer.com. Download the free cost analysis template from the website. It is pre-built around the 3 money buckets. This is the framework. It's got your materials in it. It's got your margins in it. It's got your profit margins in it with your markups. So fill it in on your next quote. See exactly where your margin sits before you send a single number to the client. There's no guesswork, just clarity. So if this episode made you think differently about how you price, share it with somebody out there who thinks they may need to work on a few things or wondering why they're losing money. One fencing operator sharing this with another could literally change the financial trajectory of their whole business. Okay, so this is how important it can be. You can make one little tweak, get to know a little bit around your numbers, and it'll change your business and take some pressure off. Next episode, we're going to talk about the TPF system, the profitable fencing system, the attract, the filter, the convert, retain, and ascend, the framework that ties your whole operation together. So you don't want to miss that one. I'm Simon Davis. This is a Profitable Fencer. This is a fencer's life, lessons from the trenches. Go fill those buckets.
Thanks again for listening to the Fencer's Life podcast. Be sure to follow on Twitter, Instagram, or the free Facebook group, The Fence Posts. And of course, Simon's personal Facebook, facebook.com/Simon M. Davis 1. And also check out Spotify to get weekly episodes. If you believe Simon can help you make a difference in your fencing business, please reach out to him on Messenger or visit his coaching mentoring site at theprofitablefencer.com. Until then, stay safe and happy fencing.